Today is a really big day. It's July 24th, and the much anticipated Bank of Canada rate announcement came out today. And we have, as expected, another cut, 25 basis points. Here today to discuss the ramifications of this big announcement, we have Jason Friesen, who's a managing partner and mortgage agent at Outline Financial, here to join us today. My name is Ralph Fox, and I am the co-founder and broker of record of Fox Bear and Associates. And welcome today to the Toronto Real Estate Podcast. This is going to be so exciting. This has been so much anticipated, a little bit more much needed relief in the markets and households. Jason, how are you today?
I'm fielding a lot of calls. I just want to say also, thanks for having me back. I always enjoy coming on here. And seeing two back-to-back rate cuts after seeing, what we witnessed in 2022 and 2023 is obviously very welcome news to people. Variable rate clients looking to get into the market, anyone that's got a line of credit. I think it's great news. And, on top of seeing these two cuts, Tiff Macklem left the door open for more rate cuts if inflation continues to ease. So they also dangled the carrot that, more rate cuts are on the horizon, provided the economy moves as expected and we see inflation continue to cool.
So there was basically a 90% consensus out there that we would actually have this reduction that we got today. As much as this was not a shock, I think people were very happy to see it actually come to be in reality. It feels like we've been in this heightened interest rate environment for some time now, and starting to see the trend coming back down is pretty nice to see, especially given all of the pain that's starting to be inflicted across all levels of the economy. We had retail numbers come in really, really soft for the month of June. Employment is continuing to weakening as well. So we're starting to see a lot of trend lines that the economy is under duress. And I think when you dig a little bit deeper under the hood, you start to realize that it's maybe even worse than the numbers may indicate at first blush. Definitely really, really great to see. Now, what happens here in Canada is really affected by the U.S. Jason, what do you foresee happening with cuts in the U.S. and how does that impact us here in Canada?
So I think, the reality is that there really is only so much we can do as far as cutting interest rates without having the Fed in the US start to cut. Potentially another cut or two that Canada can do without the Fed on board. We've got July 31st, so next week we have the Fed announcement. There's been a bigger call for the Fed to slash rates. Who knows if it will be in July? It looks like it's priced in quite heavily that we will see a cut in September. So obviously, we'll be watching closely next week. It's crazy the amount of anxiety and buildup to these rate cuts. It's like, are these rate announcements, I should say. Everyone's following this much more closely than they did in years past. Like, the average consumer didn't, wait for inflation numbers or employment numbers or GDP numbers to come out. And now this is like, it's a big thing, right? I mean, everyone has been impacted in a negative way by these higher interest rates. And everyone is feeling close to stretched, whether, they're someone that is, even locked in at a low fixed rate they took 3 years ago. The cost of everything else has increased so much that, people are definitely at the end of their limit. So seeing rates start to come down, definitely, as I mentioned earlier, is a big sigh of relief for people.
I think watching what happens in the U.S. Next week is important. From what I've read, it's almost at this point 100% bet in the markets that there will be a interest rate decrease out of the Fed in September. Not as convinced next week. But one of the things I find really interesting is when you start to look at what's happening in the U.S. and you don't think about the equities market or the NASDAQ, where you're looking at NVIDIA and Google. I mean, that's not really representative of what's happening in the marketplace in the US. And I think when you start to look at small businesses starting to become under duress, you're seeing a lot of indicators that would lead one to believe that we could see a rate cut coming out of there sooner rather than later. And it's important to understand that our loonie starts to get under pressure if we start to do too many decreases relative to other strong currencies, specifically the US. But it's also interesting to note that it's anticipated that other central banks are going to start to be reducing at the same time. And I think it's clear, and one of the things I've learned over the last couple of years is they seem to do things in a very coordinated manner. So, you got to think that Tiff is picking up the phone talking to Powell, and they're talking to the Bank of China, and everybody seems to be a little bit coordinated in terms of how they act. And I think we're seeing that play out. And from what I've read from economists, we have about a 75 basis point differential between Canada and the US. So right now we're at about that 50 point mark. So one reduction either now and in September definitely would leave the door open for us to do another reduction here. And I think once we get to that 75 basis points, I think that will start to affect the market, and we'll start to see a little bit more confidence with people starting to look to buy or make moves again, as opposed to just hunkering down. Is that how you see it, Jason?
Yeah, and I also want to touch on a point. We're talking about what's happening in the U.S. We're seeing credit card delinquencies start to increase. We're seeing mortgage arrears starting to rise. We're seeing insolvencies and bankruptcies starting to increase as well. So, it's not just looking at NVIDIA, for example. It's looking at like Main Street America and feeling what's happening. So, I think what we're seeing in the economy and what you're reading, kind of in the headlines, and it isn't always the same thing. I do think that, we will see, the Fed move either, next week, which would be ideal, or in September. Obviously, no one has a crystal ball, but based on, continued softening of both economies, it started in Canada a little bit more. Now the US is starting to show some softening. So I think we are headed for a cut, and that will also open the door for the Bank of Canada to become a bit more aggressive at that point in time as well.
You're also seeing a weakening in China and in Europe. So it's becoming a global scenario right now.
Like if we're looking at where, the big banks forecasts are as far as interest rates. So the overnight rate, which is what prime rate is tied to. So the overnight rate is now 4.5%. It was at 4.75 yesterday. Prime is 2.2% above that. So prime is 6.7% as of today. That 4.5% overnight rate, the banks are forecasting anywhere between like 1 to 1.5%, 1.75% in further reductions by the end of next year. So, you start looking at prime, in the fives or potentially even in the high fours. And if we remember, I think the market, the real estate market, works well in the fours if interest rates are in the fours. What we've witnessed the last couple of years with, we had fixed rates, in October, a 3-year fixed rate was at 6.6%. We now, for the most part, have, say a 3-year term below 5%. So we've witnessed already a pretty significant reduction in interest rates. I think we just need to continue to see, rates come down, and hopefully that will spur some activity. I think also, it is end of July. It is a bit of a slow time in the market. So I think September is going to be really telling. What are you seeing on your side? And what are you advising your clients if they want to list a property? Is it wait until September?
Depends on the property. I just received a call from somebody who has a condo downtown, 1-bedroom, somewhat generic, tenanted. I just told her not even bother. That's the type of market right now that's just completely flooded with very little buyers, tenanted 1-bedroom investor units. It's something we wouldn't even take on because you're not even going to get showings. You're not even going to get people in the door looking for that type of property. And, a year ago, there were people who were ready to jump off the cliff and we told them to hold. And we've already seen now 50 basis points. And I think there's certainly a significant amount more to come. Yeah. So if you're in that type of position, again, the recommendation is going to be to hold off. If you have low rise, houses are still doing okay. Semi-detached and detached. If you have a decent enough property or it's priced properly in line, your expectations are in line with the market, you're going to do fine. And the best type of person right now situated in the market is somebody who can buy without having to sell. And if they can do that, they can capitalize on buying at the bottom or near bottom of the market versus somebody looking just to sell off a property to pay down debt. They're going to have a tough time in this market.
I know it's impossible to completely time the market, but it does seem like in there are some pretty good opportunities at this point if you're looking to get in that potentially may not exist, 6 months from now, right? So
For sure. And if you have a strong down payment, that will
yeah.
really help.
And you're ready to go. Yeah, we've had a few clients that have ran into situations where they've bought a home and they're unable to sell, and the market almost turned on a dime. And that's not something I ever give a client absolute green light to go ahead and do. We always have to work through a worst case scenario, and they'll make an informed decision to decide if that's the risk that they want to take. Years past, that risk was a pretty small risk, and now it's coming to reality, and it maybe involves having to refinance and carry two properties short term, and borrow additional money. See if family will provide a gift. So I just from my perspective, from the financial side, if clients are looking to do something like that where they're thinking about making a purchase without selling, it's having that conversation and mapping out the worst case scenario and seeing if they have the stomach for it, right? And if they do, then obviously it's a decision that they will make and understand that there are risks involved. If they don't have the stomach or the means to come up with it, then I think at this point you're putting yourself in a really risky situation and assuming a lot of potential additional costs that add up quickly when you're carrying two properties, month over month, right? With no income or anything coming in to offset it, right? So I think that's just a real conversation that we're having much more right now that we're seeing on our side. We're just making sure clients are making the right informed decision and not blindly just buying a place and expecting that their house will sell in, a week when they list it on the market.
For sure. Up until a couple of years ago, maybe a year and a half ago, you just would buy first and then sell, knowing the challenge would be on the buy side and it would be no problem on the sale side. Now the conversations are so detailed, complex, and ongoing that it requires a lot of thought in terms of how to best move in this type of market. Because despite the economy, despite interest rates, people die, people get new jobs, people get married, people get divorced. There are people who still have to make moves at a time when most people are hunkering down. And those are the people, when they want to move themselves into a new scenario, really, really, really meticulously have to do a deep dive to understand where they're at, what they need to do to achieve, and what is the worst case scenario, and then how to build themselves up from there. And so from our end, what normally would have been, 20 hours in conversations, sometimes is 40, 50 hours. And what normally would be, a week or two to put somebody on a path, sometimes can be 6 months to a year and a half right now. And that's the challenge of being in a very nuanced type of market where people are looking to make moves or being forced to make moves given changes in their personal circumstances. And I think that's why if you are looking to do something real estate related and you live in Toronto or you want to get into the market, it is super important from a real estate side and from a finance side to have really, really, really great resources and to have a great team behind you, because otherwise you can end up in the type of spots that sometimes you and I have to try and come in and clean up
exactly
later down the fact. And you don't want to be that person in that position.
I find sometimes, obviously, we work with banks, but, we have clients that walk into a bank branch directly and talk to someone at the counter. God. It's definitely the blind leading the blind, right? It's don't do that. Exactly. It does require some expert care here. It really does, and to your point, if you are going to be making moves in this market, and there still are, there's some great options, as you mentioned, for people that don't have to sell a house, or people that, have to sell a house but are reasonable and do have a backup plan. There potentially are some options that, looking back a couple of years from now, clients could look at it, with a smile on their face, knowing that it paid off, the move that they made paid off. But it's really mapping that out, and again, making sure that clients do have a plan B and even a plan C in place, and what that looks like, and knowing that before you make an offer versus trying to figure it all out, on the fly after you're, after you purchased a house and are under the pressure. It's stressful buying a house in any market. So throw the complexities of what's going on right now. And, I don't know how you as realtors do your jobs. There doesn't seem to be a lot of rhyme or reason on which house sells at what price and with how many offers and how fast. And you'd have two houses side by side, and one could sit for a month and the other could sell in 3 days, right? So it further, this market being, weird, I think it's a great way to describe it, right?
And definitely not for the faint of heart.
Yeah.
For sure. So we've had now our second cut. What impact do you think this will have on the market based on conversations you're having with people looking to get approved or refinancing? And where do you think we will need to be in terms of future cuts before things start to really, really, really turn around?
I think rates need to be, firmly in the mid fours from a fixed rate perspective, and then just continued downward pressure on prime. Seeing a half point a decrease in interest rates, it equals about a 5% increase in qualification. So, seeing a 0.5% cut, you're qualifying for 5% more than you did, prior to the first cut in June. If you're looking at it, from a monthly payment perspective, 0.5% in cuts per $100,000 of mortgage a month is roughly about $30. So a $600,000 mortgage, you're saving about $180 a month, somewhere in that range. But we're going to continue to see these cuts to make, it much more affordable. And keep in mind, these interest rates, you have to add 2% still, to qualify for stress tests. So you still have clients that are qualifying close to like 7%, in some cases, well into the sevens.
There's an upcoming OFC meeting closer to end of year. Do you see OFC helping out a little bit there with affordability, or do you think they're going to stand firm with that 2%?
I imagine they'll probably stand firm. I know there was some hope last year and nothing came to fruition. I know there's been some talk about it, but I feel like it's just been talk. It'd be a pleasant surprise, but it's not really something I would bank on. I would love to see 30-year amortizations for all insured mortgages, not just for new constructions. And it would be great if they expanded, CMHC mortgages up to, say, a $1.2 million purchase price. I think it would open quite a few more doors in the city. But, I think the head of CMHC last year said that they didn't want to, add more fuel to the fire and make it easier. The 30-year amortization was a good step. Again, if we see that for all property types that are CMHC, I think that would be a decent boost. We do have, an increased RSPs, a limit that you can borrow $60,000 each, the FHSA account where you can potentially each put, a couple could put each like $40K into it. Obviously the rebates on the land transfer taxes are still there, but there's a barrier to entry. It's pretty high to get into a property, right?
Absolutely.
So, I think more still needs to be done to help first-time buyers.
Where do you see interest rates by the end of this year? Let's just make it easy with the overnight.
Another 0.5% in cuts, maybe.
Yeah, I would agree with that. Yeah. I think our economy, if you take away the noise of GDP and you look at GDP per capita, we are hurting and have been hurting for quite some time. And if you look at the employment numbers and you start to realize that the majority of the new employment is coming from the government and the civil service and not from small business or private business. Yeah. If you really start to dig underneath the hood, what you'll realize is that, in my opinion, the numbers that they're using to base CPI, when a third of the inflation numbers are based on housing, and the majority of that is coming from interest rates, then you're rising interest rates on top of interest rates, and you take that out, and we're lower than where we were before the pandemic. We're at about 1.7 or 1.8, something like that, well under that 2 to 3% threshold. Yeah. So, I really question the Bank of Canada. I think that they came in too late and they were forced to come in very aggressively when they could have gone in slower over time. And now I think that they're coming in late, and I think that there will be some type of price to be paid in the economy as a result of that. Yeah. I think they've missed the boat yet again. But I do agree with you. I think we'll definitely be at 4% lending rate. And I think there will still be further to come in 2025 when a lot of this pain starts to set in. But definitely great opportunities in the market right now if you're in a position to buy. And as you said earlier, Jason, if you are looking to do something, a lot of thought needs to go into a situation so you don't end up unexpectedly in a worse situation than you ever thought you could be in. Awesome. Well, Jason, I think that wraps it up. Is there anything else you have or you want to talk about with today's announcement?
No, I think, I think we covered a lot. And to your point, there is a value in working with experts, especially in a market like this. I think there was a point in time in 2020 and 2021 that your neighbor just became a realtor or your friend just became a mortgage broker and you'd work with them. That is not who you need in your corner. You need to have a team of experts in your corner that are going to be able to help navigate through this. And if you are going to purchase and buy a home, you just need to make sure you got the right team in your corner. And again, it's just something that could pay off quite handsomely over the long term, but you just need to make sure you have a firm grasp of what you're doing now and have the right people to help maneuver you through this market.
Awesome. Jason, thank you so much for joining us yet again on this momentous rate cut day on July 24th. I really appreciate having you here. And as always, your feedback and commentary is so welcome. And if you have joined us today and you've made it to the end, thank you so much for tuning in to the Toronto Real Estate Podcast. Please be sure to hit that like or subscribe button so you can stay in touch. If you have any comments, we'd absolutely love to hear from you down below. As long as it's constructive, please be sure to share your thoughts. And if you have any questions, you can always reach out to Jason or myself, and we'd be happy to answer any questions that you may have. I hope everyone who's watching this has an absolutely wonderful day, evening, and or morning. Thanks so much for tuning in.
Thanks so much, Ralph. Take care, everyone.
Bye-bye.
Bye.